Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott weight outlook, and the long-short report covering all asset classes.
Hi everyone, this is the 24th of April 2024 and I'm sure everyone's by now tried out Strike. Just go to web.strike.money. That's the new data analytics platform that you would want to get hold of because you can do all your data monitoring, scanning, sourcing, charting in one place. Now, having said that, this is a podcast coming after a while. I've been on a long holiday, and the first thing people ask me, how was it out there? I mean, I was in the United States, mostly on the western coast, and people want to know about the recession, about how hard things are. Do you really have inflation? Those are the type of questions I'm getting right as I step back into Mumbai. Of course, it's been a little more than a week adjusting to both time and the heat, which is super because I've suddenly gone from 12 to 15 degrees to 28 to 35 degrees on a daily basis. Now, that is some major shift that you have to do. But I think I'm getting used to it now. And of course, we've been here before, and so the body knows it. But yes, it does hit you that you've taken a big shift. Now, on the other part, which I know everybody wants the answer, what was it like out there? And the truth is that if you are really in some of the good parts of the country, you may not really feel so much, but you do see a lot more homeless people around. So you do see a lot of people, walking around who have, appear to be in trouble and may even be asking around for help or other things. But I do hear about a big jump in crime rate. So I think that is one of the offsets that has happened with this whole, inflationary cycle, or should we say all the asset repricing on the way up, which has benefited a lot of people, but not everybody. It's definitely created a discord, which, I've heard earlier from Ritesh about how it was in Canada, but I hear a lot of it even in the California belt, right? That crime rates are up. People are scared to leave things around. They just get stolen. If you leave your bike, even if it's, locked on the road, people have had their bikes stolen from, parking points, which are more lonely. So it's not something that people will easily do. You're scared of cars being broken into and things like that. It's not that these things didn't happen before, but the rates have definitely gone up. One of the most amusing things on that front that I heard, and I am quite shocked, I didn't know, is that in part of California, there's a law which allows people to steal up to $900 without any consequences. And that is really, really surprising because it's unheard of. And because of the high level of homelessness in those parts, they said, fine, this is the law. We don't want to, make the life of these people more difficult than it already is. And such a big limit meant that people were going in and stealing from various shops around the, San Francisco area, that the entire malls and shops in that district shut down. Yeah, that's true. They actually shut down. And that's one of the reasons. Apart from, of course, the work from home, that you have commercial real estate empty in various parts of SF. So that's crazy stuff when you think about it, that, crime is easily permitted legally simply because you have more people out of job, homeless and poor. And the easy outlet for the government is, well, let them steal up to so much. I mean, it's we can't really imagine something like that yet. On the Indian Ocean. But yeah, that was one of the things that really surprised me. Among other things, inflation is real. Yes, of course, price of everything is up, specifically services. So if you're really going and eating out, and somebody warned me before I went that you'll experience this. It didn't stick in my head, so I didn't remember what he was exactly saying. But when I experienced it, now I recall that what he meant is, if you're really eating out anyway that you're billed, in fact, in many of the restaurants, when you're sitting down, the first thing they come and tell you, sir, I hope you know how it works here. Whatever the bill, we add an 18 to 20% service charge on top of it, which is essentially what we know as a tip. And that tip is predefined. It comes calculated on your bill that you just need to choose whether it's 18, 20, 25, what percentage you want to give, and gets added on to your total billing. This is how it works. So it's another way of passing on wage inflation. We could have just included it in the cost and increased the base rate of everything from say $24 to $29. But instead of that, this has been the way that they worked around it. So you still see prices that are lower on the on the menu, but eventually you're going to pay 20% more than that on the total billing that you're going to get. So it's very interesting. It's psychological, I guess, like many other things, like the $99 sale that started decades ago, that caught on, and not to go into triple digits. It's something like that. Keep the prices same, but have an add-on, so that keeps people from feeling the pinch when the pinch is actually there right at the end. So it has become expensive to do anything when you add on that much in cost, and cost of everything is moved up. It really makes you wonder how somebody, if you are on the higher income class, you may not really feel okay, fine, I'll spend a little more, and you may not feel the pinch. But if you're really in the working class, then I think it's a big pinch that's really happening. Make it difficult for you to choose what you need to buy and what you need to not buy, and think about the necessities. That's how tough life is. So that is the real scenario out there. You still don't feel, like I said, in the working class, which is most of the tech guys. Like I was staying with my brother. Most of them, while they see all this happening, they can observe it. They don't still see unemployment in the workforce that they work in, which is the all the tech industry out there. So that has not really happened, though there have been some amount of firings, but nothing that makes them feel that this is an outright recession, what they have seen in previous recessions. So that is definitely not the case in the mind of everybody, but they do see a worsening social environment because of whatever is happening. So I think that's my net take of what I witnessed there and experienced there. Apart from, of course, the very good climate that you can have, it can be cool, chilling. You can go on long walks or biking, as I did a lot of e-biking, and really enjoy the climate, which is what you try to do on a holiday. Enjoy what you can, and I possibly tried to do a lot of that, especially a lot of e-biking everywhere from whether it was in Denver or whether it was in Palo Alto. We tried e-biking everywhere, and that was fun. Various parts of the coast and even the hills and treks that you go to. And that brings us back to the market. So I'm back here looking at what the indices are doing, and we have seen a lot of zigzagging movement since January. We've tried to call a top. It looked like happening, not happening, happening, not happening, and we are still inside that imbroglio, if I may use that word, where we don't know whether it's happening or not happening. The markets bounced back the last 4 days, retraced a significant portion, 66% or more on the Nifty, 78% on the Nifty 500, the small cap index making a new high, and it will all look rosy all over again. And so are we really headed back to new highs? And that is the question, even though my weekly RMI, Rohit Momentum Indicator, remains in sell mode. I'm going to discuss this in much more detail in the long short report, but my primary concern throughout this period, and I think since late last year, which made me start sounding cautious, was essentially rising bond yields in the US. And this is in the face of what the Fed has been saying, and everybody kept telling me, the Fed saying this, what are you talking about? The Fed is saying that we are going to cut rates, right? So they almost gave us certainty that they're going to cut rates in the second half of this year. Whether it was 6 cuts, 5 cuts, 4 cuts, 3 cuts, people are now counting down the numbers. But the point is that they gave a certainty on rate cuts coming, which is why market sort of ignored everything and went up. And then commodity prices, which were also dull, started to pick up, thinking that, well, if it's all good, then maybe inflation, reflation, all of that comes right back. And so you have commodity prices rising, equity prices rising. But what you don't have is you don't have a falling dollar, and you don't have falling bond yields. So the bond market doesn't believe what the Fed is saying. But the markets believe it. And so this is the disparity we are dealing with. If you're looking at the bond yields like me and thinking that, well, if yields are back at 4.7% and if they inch up a little more, next thing we'll know we'll be at 5%, then how do we really deal with this? On the other side, the market says, no, why you bothered? We got the Fed cutting rates in the second half of the year. And that announcement of that certainty that it's going to happen is keeping the markets from being afraid of whatever may be happening in the actual markets, which is actual bond yields going up and the dollar index also rising on the back of that. So that has led to weakening currencies around the world, and definitely it must be putting some pressure on the rupee, because I don't know if there's any other reason why the RBI thought it was right to ban trading in currency derivatives. This is something I've been asking everyone and all over channels. Nobody seems to have the answer. I don't know if they gave any official explanation. They just said, oh, this is the mandate. And if I look at open interest in the currency derivatives market in India, it's really not expanded, say, over the last 2 years. Has it doubled or tripled? And there are too many people speculating or something like that. I mean, to some extent, you can say that has happened in options markets in the equity segment, but currency derivatives hardly. In fact, currency volatility has been the lowest in years for the last 2 years because of all the intervention that the RBI is doing, which makes it even more appear more safer than it is, which means maybe they sense that there is a lack of safety inside or some risk that they want to keep people from facing. Or is it not that and something else? Is it something to do with SEBI coming down on the ability of the public at large trading derivatives in general? Because there was another notice which was about getting a clearance for being able to trade equity derivatives as well. You'll have to put up an income sheet. You'll have to be maybe even clear an exam. There was some circular like that which has been floated around. It's not yet in operation, but if something like that is even being considered, then where this is going next. So this could be other thing. We're just trying to clamp down on derivatives trading in India. I don't know if that's the objective. Then SEBI scared of something else, maybe going wrong on the derivatives market in India. My only data point on derivatives and specifically futures, not even the option side, is the futures open interest, and probably this is an observation we've made since Feb, and it's still holding out. It hasn't played out in spades. Is that and there was probably an article also in the media on it, that the Nifty is around 18 times the value. I mean, rather 18 times the Nifty is the value of total open interest in crores in the futures market, right? So if you have around we cross 1,20,000 is the peak that we saw in 2008. Right now it's probably crossed 4 to 5 lakh crores, so that kind of a big, I think 4.5 lakh crores was the number before I went. And so that number, of course, it's much bigger than before, but so is the Nifty. But what's important is the ratio. That means 18 times the index is the total value of futures open interest. And when we say futures, we are talking both index and stock futures combined, so total of everything. And that's the total market. That just shows you how much leverage is there relative to where the index is today. And if it is equivalent to what it was in 2008 and 2018, where both times where the broad market peaked. Remember, 2018 is where the mid cap indices topped out and then never looked back. The Nifty, of course, held on till COVID, but swung both ways very sharply because of the broad market. And so that's the level we have reached, which again then goes back to my thinking that is this a distributive phase since January. That is still going on. So that's one data point that supports it. But on the other side, the market's momentum remains strong. It does get these sell-offs and declines like we saw in the mid of April. But suddenly, last 4 days, we've seen a sharp retracement. And we're really trying to judge whether this is just a retracement or just like the previous 2-3 occasions will be again attempted to touch a new high. Now, we are in the gap zone. I don't know if we have completely filled it. The gap zone is when we sold off on the 12th of April, we left a gap below 22,503 and 22,427. I think so far in today's trade, while I'm recording, it's 22,464. So the gap is not completely filled. And the gap zone basically can act as a resistance to counter trend bounces sometimes. But if the gap does get filled, then it's a sign that, bulls are, rather strong and the gap down did not hold. So we'll come to know whether that is true by the end of the day. But this is what is going on. The market is attempting to bounce back and cross that zone right now. And that's sort of on the back of a rebound that we are seeing even in global equities that were falling. But the fall in global equities, it was not just on geopolitics, which is, whatever Iran has done and what is happening in Israel. But it started on the back of rising bond yields, right? That was the initial pressure point, and then all the other news just came in and caused a near-term oversold condition everywhere. Now, that oversold condition is getting relieved by this bounce-back rally, but has the main condition really gone away, which is have bond yields really reversed? Has the dollar really reversed? And I think it's too early to say that. In fact, bond yields are sort of flat over the last 3 to 4 days. So they may not be going anywhere, which is allowing the relief. But that only leaves them to wait for the next bump up, right? Because if you're not going down, where are you going to go? You're probably going to go up. And so there's no trend reversal. It's just that they stopped rising, and that's given markets a relief. Similarly, like you don't have too much more negative news flow coming out of Israel. And so that's given the markets a relief. Now, if something new comes in, maybe we will start discounting that as well. So this is the trade setup. that I observe, after my return, and I'm trying to watch in terms of what is going on. Like I mentioned, the weekly RMI, something I write in my Sunday weekly updates, which I do pen, is that the RMI is in sell mode for the last 2 months, and therefore the markets, while they do attempt to make a new high, they sell off again and again because of this divergence that is there. So there is a divergence, there is weak breadth that was there all the way till late March, after which there has been a pickup. But the weak breadth is where you don't have across the board participation. Some sectors are going up, but others are going down, which is sort of why this appears like a distributive market to us. Where certain segments are not doing too well while others, and then when others which are doing well stop doing well, then the other jumps up, and so that rotation just goes on. The index sort of remains in the same place with a marginal incremental gain. In fact, the index which probably makes us most concerned is still the bank Nifty, because the entire structure, internal wave counting, for those who are Elliott wave analysts, is very hard to call an impulse, and therefore the entire structure over the last 1 year looks like an ending diagonal. So a much bigger ending diagonal than what we are trying to draw in Nifty is there in bank Nifty. Nifty is multi-month, bank Nifty is almost several months. It's so not multi-month, it's almost a year long. And so that's a pretty long period to see a pattern develop, which is probably why it's taking time to unwind, but it still looks the same. Nothing has happened to violate it. So that's another thing which just keeps us on our toes, keeps telling us not to get carried away by the bullish moves, but to remain aware that at some point of time, sharper, deeper, more important correction, consolidation from the excesses that we've seen does happen. But on the other side, because you have strong flows into the mutual fund industry, the fund side seems completely unperturbed by this market, despite the higher valuations and rising bond yields. Most don't expect it to affect the Indian equity markets. They say, oh yeah, if something happens in the US, fine. But then US is bond market. This is what I heard in one of my discussions. So anyway, having said that, I think the concerns remain. And unless those concerns completely go away, I cannot be outright bullish. And all the entire bearish case still remains completely open, as I've discussed this in multiple spaces since January and written in my last long short report. The next one I have started penning, so I hope to put it out as soon as possible. And if you want to read that, you need to go to Indiacharts.com or download the Indiacharts app or join Indiacharts Insiders on the website. Either way, you will start accessing content on email or on the app, and you will read these updates that I write on a day-to-day basis along with charts, and that's why we call it Indiacharts. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.